So, hello and good afternoon. I welcome you to today's weekly market outlook on Friday, the 8th of February, 2019. This is Jens Klatt speaking, and I'm presenting you here my ideas for the upcoming week of trading for Admiral markets. We want to have a look at what economic events could drive the markets. What is the current bias? Probably you have the chart open right now and see that the DAX right at this moment is about to attack his intraday lows again. And I want to be honest to you, after yesterday's I think sell-off is a little too much probably, but nevertheless it was a quite sharp drop. And with the market then after the daily close yesterday eyeing 10,970, 11,000 points, it comes with no big surprise that the selling pressure continues today, especially with the significance, lower time frames, and especially the hourly chart, as we will see in a few minutes here. With the significance of this region, well, it's no big surprise that the market is about to attack this level again, and probably we'll see a very, 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 very weak weekly close here with a push as low as 10,800 points. And it highly depends on what the US equity markets will deliver in around 2.5 hours then. But before we start and before we go into further details here about the current bias, economic events, and so on, first of all, very important, we have to have a look here at the risk disclaimer that's trading with financial instruments offered by Admiral markets that they carry a high level of risk, which is not suitable for all investors due to their complex nature, and that you please, before entering into a client agreement or making a transaction, that you please make sure that you read the terms and conditions of the service from Admiral markets. For any further infos on this risk disclaimer, please feel free to reach out to the website admiralmarkets.com, where you find the risk disclaimer for further information. There you also can get the so-called kit, the key information documents with everything around the offered products and so on. We have to have a look here, as usual, at the differentiation now taking place since August 2018 after the ESMA decision, so-called ESMA decision, with the differentiation now between retail clients and professional clients, which impact this decision in general, and what it means here when trading as a retail and when trading as a professional client. So there's now leverage restriction in place for retail clients with a max of 1 to 30 on Forex majors like EURUSD, USDJPY, pound sterling against the US dollar. It's no coincidence that I mentioned exactly these, since we want to have a look here in the upcoming minutes also on these Forex major pairs. But nevertheless, there's also from time to time here in the weekly market outlook, so-called minor currency pairs, or crosses, we can also call them crosses, with a max leverage of 1 to 20. One example, for example, is CAD JPY. The trade finally triggered the take profit level. Some of you might recall that we pointed out a very attractive seasonality here over the last 23 years with a quite interesting hit rate and payoff ratio. Details on that later, but also 1 to 20 leverage cap now on CFDs and indices like the DAX 30 or gold, for example. But this is in place for retail clients. Professional clients are not affected by these leverage restrictions here. Professional clients can still trade CFDs with a leverage up to 1 to 500 here. Now, the interesting thing, and which is worth to note here, is the negative balance protection, especially. So retail clients now have an unlimited protection against negative balances. And professional clients, and this is what makes the offering from Admiral Markets very interesting, is that they have balance protection here up to 50,000 pounds sterling according to the policy once the account goes into negative territory due to market conditions. Nevertheless, not everyone can apply for or to be a professional client. Therefore, several criteria has to be met. 2 out of 3. Further details, please feel free to contact Admiral Markets here on further informations. If you're interested in that, it's probably an idea, an option for you, but only if you meet these criteria here. and only if you apply from yourself. By the way, it's not that the broker is allowed to reclassify you or something, but you have to go there. So this is me, and the face to the voice you're currently listening to. I'm located in Berlin, Germany. That's probably something you already know, respectively, could have guessed after I said good afternoon. This is a global webinar, so probably it's good morning or good evening for you too. I only want to take the opportunity here to point out why Admiral Markets is of interest for many CFD traders, and how we refer to Admiral here in Germany. So in Germany, we say, when talking about Admiral Markets, we are talking here about the DAX expert, because Admiral Markets offers a very, very competitive offering in terms of the DAX, in terms of pricing, in terms of execution speed and everything. And it's definitely noteworthy that this is the case, and that you please feel free to reach out to Admiral Markets here directly for further information on that. There's also a very attractive offering in terms of FX with the reduced spreads now. You can find every information on that on the website. So Admiral Markets is a global broker, so with offices around the globe here, and not only in Europe, but also, for example, in Chile, or also in Australia, for example, with several regulatory bodies overlooking the business from Admiral Markets. Also here, feel free to reach out to Admiral directly for further information on that. And here are the contact details. So if you want to reach out to Admiral, there you go. Just screenshot this screen right now, or go to the website admiralmarkets.com here. And so finally, we want to have a look at our agenda and what we want to look at in the following minutes then. So the questions we want to answer today is, what are the key economic events in the coming trading week? So have a look at the economic calendar. See, we also want to have a look here at the current bias in the FX and equity and also commodity markets. The FX markets are, to some extent, very volatile right now. It's not a shame, but it's like you're looking at this and just thinking, come on, move just one bit, especially when it comes to currency pairs like, for example, EURUJPY, but also EURUSD. Very, very interesting structure. So you can clearly spot, there's something we will see, a trending structure here in the lower time frames, but the intraday volatility is like 30, 40 pips, and this is a big move, to be honest. And nevertheless, somehow the feeling grows that we are probably about to see some kind of risk-off move rather sooner or later hitting. So volatility is still very subdued, but especially with tensions building around the trade negotiations between the US and China, there's a good chance that rather soon or later, especially the JPY crosses probably will face some higher volatility, and probably dollar JPY becomes very interesting here from this perspective, with somehow having big trouble to clear 110 here, psychological relevant level. We pointed out already several weeks before, and where we right now find quite a strong resistance. And sure, we also want to see whether there may be some trading opportunities arise from the current situation in the markets. And so with this, we now switch over here to the markets, and we switch over to the DAX. So very, very interesting to see that what's happening in the DAX. We just broke 2 new daily lows, and especially here on the 5-minute chart, what we have here, you can clearly see this. So just to give you an idea of, oh no, that doesn't make sense to look at the 5-minute chart, because we don't want to draw an intraday trading setup here. What I can say is that based on the so-called open range breakout, from time to time you find ideas on how to trade such an approach here on the DAX, but also on the S&P 500. You find it from time to time on the website in the traders block. Let me just probably show it to you before we start over here with the fundamental piece. So let me just guide you to admiralmarkets.com. And then in the header, and why do I do that? Because there's a piece readable, not on the DAX, but on the S&P from yesterday morning. So you go here to analytics and the traders block, and there you can also find the setup for further information. So here is the S&P 500. It's another aggregation. So in the S&P, I'm looking at the 50-minute time frame, and on the exponential moving average 10 as a filter, whether to go long or short. In the DAX, it's the 5-minute chart, and a 50 EMA exponential moving average, EMA 50, I look for here to identify the advantage. Further information here, you can find it in the traders block. You can click on it, and it's very detailed. So you can see here, it's not only a big picture, let's call it, a daily chart, but also if you scroll a little, you can see here how to identify the range, and also here, sure, slightly above that, how the definition for this range and how to identify the trading opportunity and everything, how this then can be identified, and here how the trade played out, for example. So S&P 500 in this case, just scroll a little, go on the second page, and you will find an example for the DAX here. And but nevertheless, we don't want to dig into this too deep into this matter right now, because the setup was already triggered in the morning, is still in play, in fact, because so the thing is that here were the lows which weren't triggered. Oh no, I'm sorry. By the way, it's not in play anymore. It was a long trade. The long side was triggered here, and then the market now dropped and it was stopped out. We have to put it that way around. So usually you find in the traders block an example where it played out. In this case today, it didn't play out, so we were stopped out. And yeah, so again, further informations here. We want to have a look at the in the traders block. Further informations. We want to have a look at the bigger picture, and probably zoom out a little just to give you an idea of what just happened yesterday and why this is, in my opinion, kind of a big deal, especially now with the market pushing as low as 10,935. So what just happened was the following. We have a sequence since the beginning of the year after this, let's call it sell-off into or between Christmas and the New Year's Eve here, due to several developments taking place in the White House, let's say, also around the Fed. And then the market started to take off on the 4th of January due to very good NFPs that day, but also Jay Powell standing up and saying that they're closely monitoring what's happening in the markets and that they are ready to act if volatility continues to rise, and if the markets do not show any signs of stabilization here. That was considered to be, kind of a, let's call it a Powell put. So it looked at the end of December at the meeting on the 19th of December, it looked somehow as if the Fed just removed the so-called Fed put. So doing exactly what I just described, what Powell reinforced on the 4th of January. He talked on the 19th of December. He talked about further rate hikes, which are possible, but also on a balance sheet runoff here, which will run on autopilot. And by the way, this is very important because that was just removed in the sentence, in one of the sentences in the last statement from the Fed in the last week on Wednesday's Fed statement. And it shows that the Fed put is back in play. But it was also one driver in addition to what just happened around Donald Trump, especially, and the trade war fears, let's call it, the U.S. shutdown, but also his U.S. Treasury Mnuchin, calling or tweeting, it was a tweet, from his holiday in Mexico, Cabo. It was on 21st or 22nd of December that he just called Wall Street CEOs and assured that enough liquidity is there just in case if markets keep on being volatile as they were the days before, weeks before, which was like no one was screaming fire, and then the U.S. Treasury comes out and says fire, and everyone's like, who's talking about fire? No one was seeing a fire right this moment, and I still think there is no big trouble, or there was no big trouble. Nevertheless, the assurance that that they have enough liquidity, and also bringing in the plunge protection team, in addition to Jay Powell from the Fed, then reinforcing the Fed put to some extent, all resulted in this push higher, also in the DAX. It was not only the U.S. equity markets, but it was also the DAX was pushed higher. So there were several consolidations in between, but all in all, here you can clearly spot a sequence of higher highs and higher lows on the hourly chart. Here, that was higher volatility that was on the 31st of January, where we nevertheless didn't push lower, but stabilized around 11,040, 11,050 points, and then closing the week significantly higher, 100, 150 points back then. So the sequence of higher highs and higher lows can clearly be spotted. Now, the interesting thing is that this is the last relative low, around 10,970 to 11,000. And after the market now pushed higher and making this the last relative low, holding in play this sequence of higher highs and higher lows, we know broke below that level, which was, I have to say was, in the morning when we first pushed here to this level, was kind of an interruption of this structure, but it wasn't clearly a break. What do I mean is the following. So let me just probably give you an idea of this, even though it's a very rough idea. Nevertheless, you have a sequence of higher highs and higher lows here. And that's not very good. Let's do it that way. So if the market now does something as it did yesterday, and therefore let's bring in this line here, and we want to make it green to show that this is a trend support, so holding this sequence of higher highs and higher lows. If the market now does the following, as it did here, we can, or some call this a break of this sequence of higher highs and higher lows, because again, a sequence of higher highs and higher lows is defined as higher highs here and higher lows. And now, if you break this, the trend can be considered broken. The only thing is that from time to time you have, you have such a move, and then the market takes off from there, making new highs. And at the end, when looking with some distance at the same chart, you identify this push lower here as kind of a, let's call it, stop fishing move, or as only an interruption of this sequence of higher highs and higher lows, while the overall structure, bullish structure, still remains in place. So now, what I consider to be a clear break of this structure, there's two ways to do that. The first one is the market retraces from here and then goes for another push lower, making new lows, and then start to forthright a sequence here of falling highs and falling lows. This is a clear break of this sequence then, and we can definitely consider this to be a break of the structure. But there's also another thing, because now just assume that here, that this push goes really, really, really deep for whatever reason. So like this. Then we are not talking about an interruption anymore, but I consider this to be a break of this trend structure too. And I define it based on the distance we pushed below the relative low here. So it's not only a short spike, stop fishing move, and then the market retraces, but it really pushes significantly below that level. And let's say, I think a good estimate is something like 20%. It depends on your personal preference, but in my case, it's around 20%. What I mean is the following. If this move, for example, is 100 points down to this level, and now the market not only moves 100 points, but 120, 130 points, then the break is significant enough to say it's not an interruption anymore, but it's really a break of the structure. So while we're here talking about 100 points, in case of the DAX, we're talking about a move from 11,000 and around 400, 390 around, down to 11,000 points. So this is nearly 300 points. And now if we go with the 20% rule here, we have 400, or it's more like, it's like 390, 380, 390 points. If we go now with 20%, that means that we are going 76 or something between 70 to 80 points below this low here, which we are about to do, or which we just did, in fact, because here the low was around 11,000. It was nearly 11,000 points, and now we traded as low as 10,900 and Okay, still 40, still 60 points, but in my opinion, we can really start to consider this a significant break and a break of this structure here. So now the thing is, the market looks also very, very extended. When looking at the daily chart, this is the direct dominator of the DAX hourly here. We look very, very extended. It becomes even clearer when looking at the Dow Jones, for example, where you can see it was, by the way, January was the most bullish month since 1980-70. So we really had a very, very strong start into the year. And the interesting thing about this is everything took place below the SMA 200. Everything took place here below the December highs, which means it's nothing more than in my opinion, bear market rally, what we just saw, which means everyone is probably now saying, wow, we made it back to once 25,000 points. Great. It's great to see that the market recover from those extreme lows here. And somehow it seems, yes, sure. I mean, we don't really know whether the US and China will find a solution. Yesterday, we got some news directly from Donald Trump, if I'm not mistaken, by the way, that he does not plan to meet Xi Jinping, the Chinese prime minister, before the deadline here in terms of the trade negotiations of the 1st of March. But still, you have the feeling rather sooner than later, they will find a solution. As similar to the Brexit negotiation. So it's somehow very, very likely that they will find a solution here. Nevertheless, the thing is that the market is probably right now realizing, and this is mainly due to several data sets which were published, like the NFPs, for example, last week on Friday, that all in all, we are still heading towards a potential recession. Numbers are still good and they're still solid, but to be honest, you just get the feeling that we are about to enter a very, very difficult phase of the economic cycle. And for example, last month, the numbers for the NFPs came in at 304,000, which is at first glance, a strong data set, but on the other hand, you also could see that different to the numbers from January here for the month of December, the 4th of January, that we didn't see a push higher in average hourly earnings, but it was the complete opposite. We saw a drop and we came in below expectations. Month on month, it was 0.3, while we only came in at 0.1. The same time, the employment or unemployment rate ticked higher, and this clearly countered the good reading of 304,000, which were published from the NFPs here. And so with all this, this whole move here looks very, very, very how to say that? It's like it does not really look sustainable, in my opinion. So I have a very strong feeling, and this is the thing, by the way, which favors the long side. This is probably a little counterintuitive, but just let me explain. I'm not the only one. If you follow the social media, for example, if you follow, for example, Twitter, if you follow some trading communities on Facebook, and they're very, very good analysts to some extent, some successful traders, and all of them just think that this is not a sustainable move, and very many of them are very, very skeptical and just think, hey, is this really? I mean, I don't think that it was or that we're not going to see another test of these lows again. And exactly this skepticism is something which is usually a good indication that we are probably not yet done on the upside. And if there's no external event really triggering volatility, like, for example, failing negotiations in terms of trade between the US and China, for example, and now Donald Trump probably standing up in a similar way he stood up here in terms of his, let's call them wall plans, and say, okay, well, then we just shut down the government. This is definitely something which is also possible, in my opinion, or becoming more possible in terms of those trade negotiations. And with this in mind, I think there's a quite good chance that probably rather sooner or later there will be another leg lower here, and depending on yeah, I mean, or not depending on, but based on the fact that the market still seems to be quite leveraged and still not deleveraged at all, even after this aggressive push lower, I think there is a serious chance that also here the next leg lower is probably even more aggressive than the one we've seen, which was already indicating some high volatility here last month. And this is something to definitely keep in mind. But as long as this this thought, let's say, persists, this is still then a good indication that we are probably not yet done, even though sharper pushes lower are possible. And in case of the Dow Jones, for example, we are definitely capable of moving as low as 24,650 to 24,700. Nevertheless, as long as we can continue to trade above 24,200, 250 here, and not breaking below this level again, from a technical perspective, this let's call it corrective move is most likely to continue here. And yeah, so with this in mind, let's switch back to the DAX. Again, there's potential on the downside for the Dow Jones also today. And when looking then at this quite fragile picture we've drawn here after this break below 10,970 to 11,000 points, I think there's a good chance that further losses happen, and then there's definitely some potential on the downside down to 10,800 points. And I think this is definitely noteworthy. It's a very interesting development, because yesterday, and there we come now to this Bloomberg article, yesterday a news hit the wire, which is usually, or which was, let's say, positive, or should have been positive for the DAX. What do I mean is, well, if the headline reads EU slashes growth forecasts and warns over Brexit and China, and especially warning about the economic events here in Germany and also especially Italy, well, we have to say that this is usually very positive for equities, because it usually means that we should expect not only the ECB to postpone a potential rate hike, but it also means that they're more likely to probably it increases the chances that the ECB will, in one way or the other, deliver more liquidity, which is usually positive for equities. So if this is not what the market wants to hear right now, but now a bias starts to develop, under which markets clearly show that they are very, very skeptical about the overall economic developments here, very uncertain about the developments around the Brexit. I think that the only thing we are probably getting to see here is a short bounce, if at all, and that this bearish momentum will likely continue here. And well, so far nothing bad happened, let's say. So when looking at this chart, yes, the structure can be considered broken now, and we are not bullish anymore. On the other hand, skepticism starts to rise from a technical perspective once we go below 10,800 points. But, and this is the thing, if especially US equity markets start to also take on serious momentum on the downside again, this move could happen faster than we right now might imagine it could happen. And especially if the news around China and the US and their negotiations do not really brighten up, and really Donald Trump is not willing to meet Xi Jinping here before the deadline of the 1st of March, well, then I think there's a serious chance that the DAX can aggressively push lower within the days, respectively the week to come, and go for another test then. Not necessarily in the upcoming trading week, but in the weeks to come then. Probably at the beginning of March, we will see a retest of the region of the lows, 10,200 points. Probably also a short push below that level then. Yeah, and that's it around the DAX then. So now let's switch over to the euro. The funny, or not the funny thing, but the interesting thing, I think, is what we get to see in the euro right now. And this is very, very important because we could easily say that a weaker euro, and the euro is really weak, to be honest, after the failed attempt to reconquer 115 that was on the 1st of February, that was last week on Friday, once the NFPs came in quite solid. Nevertheless, if you read between the lines, there's definitely some skepticism which arises, but all in all, they were okay, and the euro was still capable of, after especially 1 week before the still to be interpreted dovish ECB, was still capable of gaining some momentum against the US dollar. Usually mainly due to these comments around the flexibility from the Fed around the balance sheet runoff. But all in all, we have to say it then looked some kind of weak, especially if you look at the performance from the US dollar. And this drop lower here and this continuation, even though it's not a high volatile market environment we are looking at here right now, if you look at the 50-minute chart, you can clearly see what I'm talking about. So there's a structure of falling highs and falling lows. And by the way, yes, so you can clearly spot the sequence of falling highs and falling lows here, which started to develop over the last days in this case. So from the start of the trading week onwards, that was here on Monday, and every bounce against the former low here was a potential sell. And so with this sequence now, looking at this sequence here, and seeing, by the way, that volatility, intraday volatility, was not really high. So because if you for example look at the current trading range, you can see that the low was marked at 113.22, while the high is now at 113.45 probably. So this is a 20 pip range, which is showing there is some drift. Yes, and there's a sequence of falling highs and falling lows, so which means the advantage can be found on the downside, even though it's not a high volatile market environment. You're just drifting lower. And this is, I think, the result of especially those news around Germany. We remember last week, for example, also the Bundesbank chief Weidmann from Germany. He said that he's very, very skeptical about the German economy. Germany is very, very important for the Eurozone since it's the biggest economy of the Eurozone, and could be considered the train which was just pushing higher and higher and higher and holding the whole Eurozone and the economic growth to a level which allowed speculations around the ECB to rather sooner than later hike rates. And not only Weidmann, but also this news headline yesterday from the EU Commission here in Brussels is a perfect sign that these speculations do not persist anymore, or are not available anymore, let's say. And it makes more, let's call it, dovish approach or an expansive approach from the ECB likely, which means, on the other hand, it's no coincidence, to be honest, that the euro is drifting lower. But what's of interest is back here when looking at the DAX, that the DAX can't take on momentum on these speculations, which is underlining from another perspective my skepticism around the DAX in general and the equity markets, and the advantage to be found on the downside. The same is true for the euro. So I don't consider it to be the most attractive currency pair right now. I think especially dollar JPY is probably even more attractive, but nevertheless, the technical regions can be clearly spotted, and based on that, it's probably interesting because you can quite good calculate the risk reward of potential intraday engagements here. If it's worth it to give it a try, an intraday trade here in EURUSD. So the target can be found in the region between 1260 to 1280 around. And if we break below this level, further losses are likely to happen. And the first target then can be found at 112. And below that level, probably not sure if it will be a kind of sell-off or it will be more kind of a drift. Probably mainly depends on the developments around the Brexit, but probably we can, with a break below 112, also see a push then down to 110 to this region. But But still, again, I don't consider EURUSD to be very, very attractive in terms of volatility. Even if you're planning to hold or to go for intraday engagements, you have to be very, very patient. Where you don't expect too much to happen in direction of the current momentum, even though you can clearly spot it on the downside, but also don't expect dynamic and volatile moves to really happen, and your potential take profit then being hit quickly. But it's more kind of a patience game then, as trading usually is, but probably even more right now when looking at the euro. So what about pound sterling? Well, the thing is that the situation hasn't changed from last week. You probably recall what I mentioned here. I said that we shouldn't expect big steps in one or the other direction between the EU and also the United Kingdom before the deadline of the Brexit, which is hit on the 29th of March. So right now, there's another EU-UK summit being planned on the 22nd to 23rd of March, so nearly 1 week before. Don't expect before this summit here big developments. All in all, we can say that the Bank of England reinforced their skepticism around the British economy yesterday in their statement, and sees a very negative impact on a no-deal Brexit. But again, this is no big or surprise. Same is true for the Eurozone, especially because UK and Germany have very tight trading relationships, and any hard deal scenario would trigger an even sharper slowdown of the economic outlook in Germany, and driving Germany towards a recession, which is one of the main reasons why I still expect the EU to make some concessions. But again, I don't expect them to be made significantly before the 22nd, 23rd of March, before this summit. So based on that, I don't see big moves to come in pound sterling, and stay nevertheless positive to some extent above 128 to 128.30 here. But all in all, the picture is also not very, very attractive. The picture looks different when looking at dollar JPY, especially here with this line in the center around 110, where we have some trouble to make it above. Probably recall a technical piece which was published several weeks ago, where I said after this flash crash, it's probably an option that we drift towards 110. Also here, I emphasize not to expect too much in terms of dynamic and volatility, but nevertheless, I said that reaching 110 is probably likely to happen, and we've in fact did reach this level. Nevertheless, a dynamic break is not happening, and after failing for several times, which you can clearly spot on the hourly chart here. So it's like as if there is it's not as if it is there a strong resistance, but obviously there is a strong resistance. So you can see nevertheless that the market, and this is interesting, that the markets nevertheless is bouncing quite sharply against this level, trading back, and now these pushes become not as big as they were before, let's say, which is increasing the chance that probably the supply being delivered against this level starts to fade, starts to diminish, which increases the likelihood of a break higher from a technical perspective. But I have to say, especially with my skepticism around equity markets, potential risk of hitting the markets, I'm more of the opinion that a stronger bounce against 110 is more likely to happen, and that dollar JPY here will rather sooner or later see a more aggressive push lower, even though, on the other hand, we have to say that everything happening above 108.50 here still is not a big deal for the bulls, because even though we can consider this overall picture to be considered, we should consider it bearish. Nevertheless, with the sequence of falling highs and falling lows after this flash crash here and all this, but nevertheless, the thing is that it's more neutral right now, the picture, with a potentially, from a technical perspective, bearish touch than it is then it is a clear bearish picture. And this is something, so the neutral touch stays in play until we break below 108.50. If you ask me now to rate EURUSD, GBPUSD, and $JPY based on their current attractivity, I definitely go for $JPY, even though volatility is low. But I think if we get to see some more volatility and or which currency pair to expect bigger moves to initiate, I think dollar yen is more interesting than EURUSD and GBPUSD, mainly due to those Brexit developments we've seen here. And now finally, before we have a look then at precious metals, and in this case gold, we have to have a look here at the dollar CAD. There was a very, very interesting development taking place. And by the way, in 45 minutes, the event being covered, let me just close this and this here too. Here in the technical piece today, in the morning, you can see it here at 11 being published in the traders block. The headline is obviously already showing you what is important today. So the economic calendar is quite thin, but here in Admiral Markets Forex calendar, you can see that today the employment situation from Canada is published. And why is this interesting? Well, it is interesting because of these developments here. On Wednesday, there was the IVPMI data set published, which came in below expectations here. So when clicking on this link, you will guide it to trading economics, and you can see numbers came in significantly below the expectation. Oh, not significant. It's okay. It's 56 and it's 57.4, but it's significantly below the reading or the print from January. And in combination with the comments from the Bank of Canada in January already being skeptical about the overall economic outlook based on trade and all this, the combination was good enough to at least initiate some bullish momentum against this trend line. So that was here the first push higher, which was initiated. But to be honest, I don't really think that was IVPMIs alone, but it was more the Deputy Governor of the BOC, Timothy Lane, stated in a speech, which is, by the way, here available with the PDF from the Bank of. You can see it here. So it's from the BIS, in fact. So it's a quite big PDF, but I've stated out what's really interesting. He said that the BOC is closely monitoring the relatively recent use of CAD as a foreign currency by other nations. The past sharp CAD exchange rate movements have helped the Canadian economy to adjust to shocks, and I think this is the most interesting and a part of this comment from Lane. He states that the BOC is ready to intervene in markets if necessary. So this is very, very dovish, in fact, and somehow underlining the comments from the BOC from January, also playing into the disappointing data sets around the IVPMIs. And now, make a long thing short, if today's employment situation disappoints, I think we're at least good for an attempt here to attack, probably even break above 133.70 to 134 on the upside. Currently, we're trading at 133, so volatility probably ahead if the employment situation in Canada disappoints too. And the data set is published in around 45 minutes, so it's 1:30 London, 1:30 p.m. London when this data set is published. So, and now some final words on gold. Unfortunately, we did not make it to the potential long trigger around 1,295 to 1,297. Unfortunately, we only here traded as low in this candle yesterday, traded as low as 302, 303, I think. And now we take on momentum again which is probably also an indication of potential risk off forming somewhere at the horizon. So usually you see demand for gold in volatile market environments. And so with this in mind, I'm very positive for gold. This is especially true as long as we trade here above this green line, 1,277. Let's put it a little wider, probably 1,275. If we trade above, or as long as we trade above that level, I think chances are still high that gold will rather sooner or later see another attempt to attack the region around 1,360 USD per ounce, the highs from 2017 and the highs of 2018, which is, by the way, also showing that some skepticism around the US dollar is still valid, I think, and we should be really, really careful of the current strength the US dollar is showing. I think, especially when looking at EURUSD, we're not really looking at a strong US dollar, but we are looking at a weak euro right now. And this is something to keep in mind. And if you want to, let's put this in quotation marks, play the US dollar, then remember that gold is usually negatively correlated to the US dollar. So if you're expecting gold to drop, usually gold is a good place to be long in, and the other way around. So that's something I just want to remind you of. And so that's it from my end. I wish you a nice weekend. Enjoy yourself. Talk to you again next week on the 15th of February, then with our weekly market outlook here for Admiral Markets. And I really appreciate your feedback. Probably in a few hours, probably it's on Monday available, the recording here. Give the video a like, or probably share it, or I don't know. Just watch out. Check the YouTube channel from Admiral Markets here for the recording. It will be available there. The written piece of what I just said, some of those points will be also made a topic in the weekly market outlook, being published on the traders or in the traders blog on the website from admiralmarkets.com on Monday. And that's it from mine. So enjoy yourself. Have a nice weekend. Talk to you next week. I look forward to it. See you, and bye-bye.